Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Today, we start with Steve.
Last week, one of the world's most renowned investors passed away. Charlie Munger died at 99. He was Warren Buffett's longtime partner and friend at Berkshire Hathaway. And on the side, he managed an investment portfolio called the Daily Journal. As an investor, he reflected the approach that we very much share, the taking a skeptical approach in investing. We thus decided to visit and make this podcast episode on his views on investing dedicated to him. Munger and Buffett are often described as archetypical value investors. However, some of their investment choices don't really seem like typical low price to earnings or price to book companies. Clem, how would you describe Munger's style of investing?
So first, let me welcome everybody to the podcast. Steve, that's a fantastic question to start this off. I would say that that rather than a relative value approach, where you would look at price to earnings, price to book, dividend yield, and other valuation metrics per se, I would say that what Munger and Buffett have been taking is an approach of intrinsic value, where they're looking at how much the business is worth, which drives their assessment of how much the stock is worth. And in that context, and we'll be discussing this a little bit more, I believe is, their view that you should buy wonderful companies at attractive prices. And so some of these wonderful companies don't necessarily have super low PE and price to book ratios.
No, I noticed today on your LinkedIn, you had a analysis of Ferrari, and you looked at the multiple as high, but so is the brand value. So I think it's a really good point. Munger and Buffett preferred companies that had unassailable moats. For example, like Coca-Cola, not just a brand because of the firm's advertising, but also a business model where it has restaurants and vendors choose between them and Pepsi. Clem, can you tell me about the concept of moats?
So, as you can imagine, a moat draws on the analogy to a medieval castle, where the residents of the castle, the king and his various princes, were able to defend the castle in part because of a very deep moat around the castle that would keep folks out, keep marauders out of the castle. So the concept of moat is a bit similar when it comes to investing. A moat is a way of being able to set yourself aside and above the competition. So either in terms of the kinds of technology that you're using, is your technology not just patented? Obviously, you want that, but something that is that can't easily be replicated by your competition.
Manufacturing process.
Yeah, a manufacturing process, for example. Or it could be something like, for example, a Facebook/Meta, where you really have no competition or not much competition in terms of being able to face competition, for the Facebook product, for the Instagram product. You just don't have any significant competition for that kind of, internet, social media. They kind of dominate that particular market. That's called basically a network effect.
Yeah, I mean, I think we know companies like Apple and Microsoft have you can't be turned around overnight. It's not like a commodity like copper that you get out of the ground one way in Chile and one way in the United States, and it doesn't change that much. So Munger also spoke about a concept called the circle of competence. Clem, what did he mean by that? And how did it help his investing?
Okay, so circle of competence is really a fancy alliterative way of being able to say, invest in what you know. So he would talk about circle of competence, staying within that circle. He would talk about sort of moving towards the edge of that circle if he wanted to get a little bit adventurous, but basically staying with what you know or what you think you know. So fairly simple businesses, ones that are pretty easy to understand. It's pretty easy to understand what Apple does. I mean, even though Apple's high technology, it's pretty easy to understand. It's really a discretionary company when it comes down to it. Even though it gets slotted in with tech, it's really a discretionary company. It's kind of easy to know what Coca-Cola does. These are, it's not difficult. And he believed that it was better. You're a better investor from his perspective if you actually have a really good sense of what the company is about and what its business model is about.
Yeah, I think it's a simple concept, but it's pretty powerful. I mean, I look at all the things that Charlie Munger, and he really tried to, I don't know, make the world around him a little bit better. And I like the way that he and, Buffett don't necessarily agree, and he pushed for Apple and Buffett resisted. And it's good to see that kind of discord. I think that's what a partner, that's why we have a partnership on this podcast. That's why I have a partnership in my business. I think it's important to be a good partner. And I think that part of what Munger was trying to move for was, he had this idea of how, don't reach into something that you don't know about and expect you're going to be able to, know the company better than the people who have that familiarity. So I think it's a great concept. So both Munger and Buffett emphasize voracious reading and the importance in everyday life. What do you think about the value of voracious reading? Is it old-fashioned?
I'm old fashioned. I'm not old fashioned in the sense of I have moved beyond paper for the most part.
All right.
But I'm not. I'm still old fashioned when it comes to the value of reading. I do read an awful lot. I haven't moved 1,000% to YouTube and all the material that's available there.
You are thinking more positively about podcasts.
Oh, I am thinking much more positively about podcasts, but I do an awful lot of reading. I read the major investment publications. I read a lot about international politics, international investing. I'm particularly even though I invest considerably in U.S. stocks, I do have an interest in international politics, international affairs. It not only affects circumstances abroad, it actually affects people in the U.S. as well. And so you can't just sort of put a wall around the United States because a lot of stuff that's happening overseas also affects us here in the U.S.
Yeah, what do you think about Berkshire's willingness to look at opportunities beyond the U.S.?
I think it's good. I think it's good. I think that, one thing that I think a lot of folks don't realize is that companies around the world sell around the world. And so you may have companies that are headquartered in Europe who actually sell a lot outside. You mentioned my piece on Ferrari. Ferrari's based in Europe. Yeah, sure, it's a European company, but it sells a lot around the world, including in the United States. So in terms of its revenues and earnings, what is it? It's a global company, right?
Yeah, I think
so you've got lots of global companies that just happen to be based overseas. So, what are you going to do? Are you going to say, I'm not going to invest overseas am I not going to invest in a Glaxo or a Novo Nordisk or a Novartis just because, those are big pharmaceuticals, just because they're based in Europe? Of course not.
No, I think it's a great concept, and I think that's why we have ADRs, and you can buy them on the U.S. exchange. It's, the process has gotten a lot simpler. I believe that the concern of some is whether the accounting standards are the same, and how do you evaluate the rigor with which they're regulated or supported by their local government, aka, airplanes in France, and how do you look at all the different factors when you can look at companies that are similar in the same accounting and the same regulatory stance of the U.S. So I understand people's hesitancy, and I also understand people's excitement to try and get the best brands you can. And I think that's what Munger and Buffett, they might prefer the U.S., but I think when they see value, they see value.
Yeah, when they one of Buffett's over the last couple of years recent acquisitions has been small stakes in each of the large Japanese trading houses.
Nice.
These are companies that have been around for ages. They have global operations. They're conglomerates, so they're in a lot of different industries. And they just happen to be based in Japan. They're Japan focused, but they're not entirely dependent on the Japanese market. And so
the Japanese are some of the biggest exporters. So if you're working with a Japanese exporting firm, it could be exporting direct. America is the largest consumer state, or the U.S. So I got to imagine that Japan's number one partner in terms
right. And not only that, but you've got Japanese companies that don't manufacture in Japan anymore, and they'll manufacture in China and the U.S. and Latin America. And so it creates a real demand for somebody to manage supply chains. And that's what these five companies do. And on top of that, Buffett looked at these companies and said, "Oh my gosh, look how cheap they are."
Right.
And so he thought,
I've been looking at some ADRs in Japan, and I just don't, the growth model and the population and how they handle immigration or don't, just creates certain pieces. I'd say there's a quantifiable part of understanding value in Japan, and then I'd say there's a qualitative state, and I think there's a lot of good reasons to be there. So, one last main question is, talk to me about the time frame that Munger and Buffett use for investing, and how different it is to say, I want to own this company and I want to never have to sell it, versus what I'll call the meme state of markets today, where we have one-day options.
Well, in that respect, I would say Munger and Buffett, very old-fashioned. You could sum it up as, we don't think we own the stock, we own the business. And when you own a business, you own it for the long run. And what helps them on that is that, Berkshire Hathaway doesn't just own stocks. It's not like a mutual fund exactly, right? It's a stock that includes lots of subsidiaries that it wholly owns, insurance companies, for example. And so it's, they have an ownership mentality. So, they say, okay, well, we let our managers manage their divisions, and that's true. But they are the ultimate owners, the ultimate board of directors, so to speak, for these companies. And that's what drives their thinking. Now, there have been times when, just like with all of us, mistakes are made. And so, Munger himself pointed out that he made a mistake and went out of sold a stock that he had only recently purchased. That was a Chinese stock,
Alibaba,
called Alibaba, right?
Yep.
And Munger went in with a view that, a long-term view, that no matter what you might think about the Chinese government, that they really were on top of things in terms of being able to bring their people out of poverty and into, a relative wealth situation, make it a middle income country from what was a lower income country. And so he had some faith in the Chinese government. It was somewhat misplaced because what happened was there was an about turn in the policies of the leadership. And this about turn resulted in lots of interventions in companies, including Alibaba. And so share prices began to fall. And as they fell, Munger reevaluated the situation and decided that long-term prospects were not good. And so he sold fairly quickly. So
Yeah,
they will sell if they reassess their investment thesis.
I think it's good to just understand how even the most skilled in tech, somebody who has all the resources and has all the experience make mistakes. I mean, it's a very simple concept, but they try to, focus on their area of competence and do the right thing. But ultimately, things happen and you readjust, and sometimes you got to make a quick change. And I think that the way they've laid out the people who are managing their investment portfolio, the leaders of their insurance business and their oil and energy businesses, I think that their brands are pretty well established. And, that leads me to the mailbag. So the first question is, what do you or Clem have personally invested in Berkshire Hathaway? Also, do you invest in Coke and Apple or some other of the stocks that Munger liked? Well, mailbag, I personally do invest in Berkshire Hathaway. I believe it's a good store of value. I think that when you look at companies, you look at how much downside you think there is. And on these names, I think they are, have less downside, and I think they will produce income. And for the purpose of this account that I have, I'm saving some money for buying a house in the next year. So I don't want to put it entirely out of the market. I could put it in bonds, but I felt like I would still have a little bit of growth with some Berkshire. Do you invest in Clem? Berkshire?
Yeah, I have a position in Berkshire. One of the things I'm astonished about is how, you mentioned low downside. I am astonished at how low the short interest ratio is for Berkshire Hathaway. It's the lowest or near the lowest of any I've actually seen, and that indicates that there are very few short sellers out there who are willing to bet against Berkshire. So again,
it could also be supply though. I remember somebody was saying for a hedge that it's hard to find people that will lend Berkshire.
yeah,
But it could be.
It could be. I would think that would apply to some other companies too, though. But we'll see. I mean, yeah. I mean, in any case, it's not a high short interest ratio. I would also say, okay, so I also invest in Coca-Cola, but not through the main Coca-Cola, but rather through Coca-Cola FEMSA, FEMSA. Coca-Cola FEMSA, that's KOF is the ticker, is the Mexican bottler for Coca-Cola. And they're 51% owned by FEMSA, which is a Mexican bottler, and 49% by Coca-Cola. And the reason I invest in them is not just because of all the things that are great about Coca-Cola, but also because you're getting the benefit of having faster consumer growth in Mexico and in some of the other Latin American markets where Coca-Cola FEMSA is situated. So that's worked out pretty well for me, Coca-Cola FEMSA, KOF. And I also invest, of course, in Apple. I'm a little disappointed, I would say, recently in Apple, but I think over the long run, Apple is a great investment, and I think it's it'll continue to compound over time, and so I'm not selling out of it by any means.
No, I have it in our dividend strategy, and I think it's it's got a nice healthy dividend, and it's going to grow it, and otherwise on the capital of in terms of increasing the price. I think it has a lot of opportunities. So I guess in summary, when I think about Charlie Munger and how he has impacted investing, I think his approach of being skeptical and looking to simplify things, I think his approach about trying to have a discourse and an analysis through reading and understanding what's happening with the multiple factors of businesses. He encourages research, but he also encourages instinct. And I appreciate what Charlie has brought to the industry and what's brought to skeptics. And so I hope you enjoyed this, and I hope you will listen to our next podcast. Clem, do you have anything else to add?
Nope. I just want to thank you all for listening, and I hope we're going to have many, many more great podcasts in the future.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.